Let us start with a simple observation. The overwhelming majority of self-made millionaires in the United States did not build their wealth through stocks, bonds, or savings accounts. They built it through real estate. This is not a coincidence. It is not survivorship bias. It is a reflection of structural advantages that real estate offers and that other asset classes do not. Leverage, depreciation, tax deferral, inflation protection. Forced appreciation through renovation, and the ability to generate cash flow while someone else pays down your debt. They are claiming that the fundamental mechanics of real estate, when understood and applied correctly, create a wealth-building machine that no other investment can replicate. The math is different. And for those who learn it, the results are different as well. To understand why real estate has such a powerful reputation, you have to first accept a counterintuitive truth. The return on a property is not primarily driven by price appreciation. It is driven by leverage, by the use of other people's money to control an asset that produces income and appreciates over time. When you buy a $300,000 property with $60,000 down, you are controlling a large asset with a small amount of your own capital. The bank provides the rest, and crucially, the tenant pays the bank. Your mortgage, property taxes, insurance, and maintenance are covered by rental income, ideally with some left over. Every month, the tenant is building your equity by paying down the principal on the loan. Every month, the tenant is paying your interest, which is tax deductible. And over time, inflation works in your favor, eroding the real value of your fixed-rate mortgage while rents and property values rise with inflation. This combination of effects, leverage, cash flow, amortization, and inflation hedges, creates a return profile that is fundamentally different from anything you can get in the stock market. Let us break down the math on a typical investment property to see how this works in practice. Suppose you find a duplex in a growing mid-sized city for $300,000. You put 20% down, $60,000, and finance $240,000 at 6% interest on a 30-year fixed mortgage. Your monthly principal and interest payment is approximately $1,439. Property taxes at 1.2% add $300 per month. Insurance adds $100. Maintenance and vacancy allowance add another $300. Total monthly carrying costs are about $2,139. You rent each unit for $1,300, for total monthly rental income of $2,600. Your monthly cash flow before tax benefits is about $461. That is $5,532 per year in cash-on-cash return on your $60,000 down payment, which is a 9.2% cash return before appreciation, before principal paydown, and before tax benefits. Now add the other components. Your tenant is paying down your mortgage principal each month. In the first year, about $2,900 of your payments go to principal reduction. That is additional equity you are building without spending any additional money. Add that to your cash flow, and your total first-year return on your $60,000 is about $8,432. A 14% return before appreciation and tax benefits. Now add conservative appreciation of 3% per year, $9,000 on the $300,000 property. Your total first-year return is approximately $17,432. A 29% return on your $60,000 down payment. That is not a typo. Leverage transforms modest appreciation into spectacular returns on equity. If you had put $60,000 into the stock market and earned 7%, you would have made $4,200. The real estate investor made 4 times that, and that is before discussing the tax advantages. The tax advantages of real estate are substantial and often misunderstood by people who have never owned an investment property. The most powerful is depreciation. The IRS allows you to deduct a paper loss each year representing the theoretical wear and tear on the building, not including the land. On a $300,000 property with land value of $60,000, the depreciable basis is $240,000. Spread over 27.5 years, that gives you an annual depreciation deduction of approximately $8,727. This is a non-cash expense. It does not cost you anything, but it reduces your taxable rental income dollar for dollar. In our example, your net rental income before depreciation was about $5,532. After depreciation, you have a taxable loss of about $3,195. That loss can offset other income if you qualify as a real estate professional, or it can be carried forward to offset future rental income. In practical terms, this means many rental property owners pay zero federal income tax on their rental income for years, sometimes decades, while their wealth grows. Additionally, mortgage interest is fully deductible against rental income. Property taxes are deductible. Insurance is deductible. Repairs and maintenance are deductible. Even the mileage you drive to check on the property is deductible. The tax code is structured to favor real estate investors in ways that stock investors cannot access. When you sell a stock for a gain, you pay capital gains tax that year, unless you die and your heirs get a step up in basis. When you sell a rental property, you can defer all capital gains taxes indefinitely using a 1031 exchange, rolling the proceeds into a larger property and continuing to defer taxes until you die, at which point your heirs receive a step up in basis and owe no tax at all. This is not a loophole. It is an explicit policy designed to encourage investment in real estate. And it works. The ability to defer taxes indefinitely means your capital compounds tax-free for decades, which is a massive advantage over almost every other investment. The inflation argument for real estate is also stronger than its critics acknowledge. When you have a fixed-rate mortgage, inflation is your friend. Your mortgage payment stays the same in nominal dollars for 30 years, but your rental income rises with inflation. The real cost of your debt plummets over time. In the 1970s, people who bought homes with fixed-rate mortgages saw their payments become trivial within a decade as inflation and wages soared. Stock market investors in the same period saw negative real returns. Bonds were destroyed. Cash lost half its purchasing power. Real estate, leveraged in fixed rate, was one of the few assets that protected wealth and generated positive real returns. The same dynamic applies to rental properties. Inflation erodes the real value of your debt while increasing the nominal value of your asset and your rental income. That is a triple win. No other investment offers that specific combination of features. Another advantage of real estate that is rarely discussed is the ability to force appreciation. With stocks, you are a passive observer. You cannot call Apple and tell them to increase their earnings. You cannot make Microsoft build a better product. You wait. With real estate, you can actively increase the value of your asset through renovation, better management, or even just painting the walls and updating the kitchen. A property that generates $24,000 in annual rent might be worth $300,000 based on an 8% cap rate. If you make improvements that allow you to raise rent to $30,000 per year, the value of the property, assuming the same cap rate, rises to $375,000. You created $75,000 of value through your own effort and capital. That is not speculation. That is value creation. And you capture that value either through refinancing, which pulls your cash out tax-free, or through selling in a 1031 exchange, which defers taxes. You cannot do that with a stock. You cannot force a company to increase its dividend. You can only hope. The leverage advantage of real estate goes beyond simple math. Real estate is one of the few assets that banks will lend against at favorable rates for long terms. A 30-year fixed-rate mortgage is a uniquely American invention, but even shorter-term commercial loans offer leverage that is not available to stock investors. You cannot borrow $240,000 at 6% to buy a diversified stock portfolio. A broker might offer you margin at higher rates with the risk of a margin call if the market drops. A bank will not give you a 30-year loan to buy Apple stock, but they will give you that loan to buy a duplex, because they have a hard asset as collateral and because the government backs the residential mortgage market. This access to cheap, long-term, non-callable leverage is a structural advantage that real estate investors have and stock investors do not. And leverage, when used responsibly, is the primary driver of wealth in any asset class. Real estate just makes it easier and safer to access. The rental income component of real estate is also often underappreciated. When you own stocks, you receive dividends, but the average dividend yield on the S&P 500 is historically between 1 and 2%. Most of your return comes from price appreciation, which is unpredictable and only realizable when you sell. With real estate, you receive monthly cash flow that you can use to live on, reinvest, or pay down debt. That cash flow is relatively stable compared to dividends, because rents are sticky and leases provide contractual income. Even during the 2008 financial crisis, most tenants continued paying rent. Rents did not crash the way stock prices did. That monthly cash flow provides a margin of safety that pure appreciation investments lack. If the stock market drops 30%, you have nothing unless you sell at a loss. If the housing market drops 30% but your rent stays the same, you still have your cash flow, and you can wait for prices to recover. The cash flow is an anchor that allows you to hold through downturns without panic selling. Critics of real estate often point to the lack of liquidity. It is true that you cannot sell a house as quickly as you can sell a stock. But illiquidity is not always a disadvantage. Illiquidity forces patience. It prevents you from panic selling during a downturn. Stock investors with easy access to a sell button often make terrible decisions, selling at the bottom and buying at the top. Real estate investors cannot do that. The transaction costs are high, the process takes months, and by the time you could sell, the panic has often passed. This forced holding period is actually a behavioral advantage for most investors. It aligns with the fundamental truth that long-term wealth comes from buying and holding productive assets through cycles, not from timing the market. Real estate makes it hard to time the market, which for most people is a feature, not a bug. The argument that real estate returns are only average when you strip out leverage misses the point entirely. Leverage is not an add-on to real estate. It is integral to the asset class. You cannot analyze real estate without leverage because almost no one buys investment property in all cash. The comparison should not be between an unleveraged property and the stock market. The comparison should be between a leveraged property and a leveraged stock portfolio. And most stock investors cannot get the kind of leverage real estate investors can, and they certainly cannot get it at the same rates with the same non-callable terms. If you could borrow $240,000 at 6% for 30 years to buy stocks, the expected returns on a leveraged stock portfolio would also be spectacular. But you cannot. So the comparison is unfair in exactly the way that matters. Real estate wins because the financing structure is uniquely favorable. There is also a generational wealth argument for real estate that is hard to ignore. When you own a rental property, you own a physical asset that can be passed down to your children with a stepped-up cost basis, eliminating capital gains taxes entirely. Your children inherit the property at its current market value, sell it if they want, and pay no tax on the appreciation that occurred during your ownership. They also inherit the ongoing cash flow, the depreciation schedule, and the ability to continue leveraging the asset. Real estate is one of the few investments that can be transferred across generations without a tax penalty. Stocks also receive a step-up in basis at death, but the difference is that real estate's depreciation recapture, which would be a huge tax if you sold during your lifetime, is also eliminated at death. That is a massive tax benefit that is unique to real estate. Let us look at a real-world example. In 2012, an investor buys a 4-unit building in a growing Sun Belt city for $400,000 with $80,000 down. The building generates $36,000 in annual rent. After expenses and mortgage, cash flow is $6,000 per year. Over 10 years, the mortgage principal is paid down by about $40,000. The property appreciates at 4% per year, reaching about $592,000 by 2022. The investor has made $80,000 in cash flow, $40,000 in principal paydown, and $192,000 in appreciation, for a total gain of $312,000 on an $80,000 investment. That is a 39% annualized return, far exceeding the S&P 500 over the same period. And the investor has paid little to no tax on the cash flow due to depreciation, and will defer tax on the appreciation through a 1031 exchange or hold until death. That is not theoretical. That happened for thousands of investors in the 2010s. The critics who say real estate only returned 1% real appreciation over a century are correct about the long-term average. But they are missing two critical points. First, that average includes periods of war, depression, and massive structural changes. The post-1945 era, and especially the post-1980 era, has seen much higher real appreciation due to falling interest rates, demographic trends, and supply constraints. Second, and more important, the appreciation number is only part of the return. The rest comes from cash flow and principal paydown. When you add those, the total return on real estate, even over the full century, is competitive with stocks, but with lower volatility and the benefits of leverage and taxes. The famous study by the Federal Reserve Bank of San Francisco that critics cite actually shows that total returns on housing, including imputed rent, are about 7% real, comparable to stocks. And that is for primary residences. Investment properties with professional management and value-add strategies have historically done even better. The real reason real estate is the best investment for most people is not mathematical in a vacuum. It is behavioral. Most people will not stick with a stock investment plan for decades. They will panic sell, they will chase hot tips, they will check their portfolio daily and make emotional decisions. Real estate forces discipline. You cannot sell your rental property from your phone while waiting for coffee. The transaction costs and time required to sell create a friction that prevents stupid decisions. The monthly rent check provides positive reinforcement. The tangible nature of the asset makes it feel real in a way that a stock certificate does not. And the forced savings from mortgage amortization builds wealth automatically, without willpower. For the average person, a real estate investment that they hold for 20 years will outperform a stock portfolio that they tinker with, even if the raw returns on stocks are slightly higher, because they will actually stick with the real estate. The calm closing thought is this: real estate is not the best investment for everyone in every market at every time. There are bad deals, bad locations, bad tenants, and bad timing. But the structural advantages of real estate, leverage, tax benefits, cash flow, inflation protection, forced appreciation, and behavioral discipline, are real and powerful. The people who say real estate is a mediocre investment are usually comparing apples to oranges, comparing an unleveraged property to the stock market, or ignoring the tax benefits, or assuming passive ownership without management. When you use real estate correctly, as a leveraged, tax-advantaged, cash-flowing, actively managed business, the returns are exceptional. That is not hype. That is the math that has created more millionaires than any other path, and that math is available to anyone willing to learn it and do the work. Like and subscribe if you want more Why Did That Crash stories. Hit the bell so you don't miss the next hidden pattern.